Mastering Candlestick Patterns for Forex Trading. Introduction. Candlestick patterns are a popular tool used by Forex traders to analyze market sentiment and make informed trading decisions. By understanding these patterns, traders can identify potential reversals, continuations, and trends in the market. In this text, we will explore the world of candlestick patterns and provide a comprehensive guide to mastering their interpretation for successful Forex trading. Understanding candlestick charts. Candlestick charts are visual representations of price movements over a specific period. Each candlestick consists of a body and wicks or shadows, representing the range between the high and low prices. Bullish and bearish candlesticks. Bullish candlesticks indicate positive market sentiment, where the closing price is higher than the opening price. They are typically represented by filled or green-colored bodies. Bearish candlesticks, on the other hand, indicate negative sentiment, with the closing price lower than the opening price. They are often represented by unfilled or red-colored bodies. Single candlestick patterns. Doji. A doji candlestick occurs when the opening and closing prices are very close, creating a small or no body. It signals indecision in the market and often precedes a reversal or a significant price move. Hammer and hanging man. A hammer candlestick has a small body located at the top, with a long lower wick, resembling a hammer. It signifies a potential reversal from a downtrend to an uptrend. Conversely, a hanging man candlestick has a small body at the bottom, with a long upper wick and can indicate a potential reversal from an uptrend to a downtrend. Shooting star and inverted hammer. A shooting star candlestick has a small body at the top, with a long upper wick, resembling a star falling from the sky. It suggests a potential reversal from an uptrend to a downtrend. An inverted hammer candlestick has a small body at the bottom, with a long lower wick, and can indicate a potential reversal from a downtrend to an uptrend. Reversal candlestick patterns. Engulfing patterns. Bullish engulfing pattern. It occurs when a small bearish candlestick is followed by a larger bullish candlestick that engulfs the previous one. It suggests a potential reversal from a downtrend to an uptrend. The bearish engulfing pattern is the opposite and indicates a potential reversal from an uptrend to a downtrend. Harami. A harami pattern occurs when a large candlestick is followed by a smaller candlestick that is entirely contained within the previous one. It signals a potential trend reversal. Morning star and evening star. A morning star pattern consists of 3 candlesticks. A large bearish candlestick, a small bullish or bearish candlestick with a gap, and a large bullish candlestick. It indicates a potential reversal from a downtrend to an uptrend. An evening star pattern is the opposite and suggests a potential reversal from an uptrend to a downtrend. Continuation candlestick patterns. Bullish and bearish flags. Bullish flag. It occurs when a strong upward price movement is followed by a short consolidation period represented by parallel trend lines. It suggests a potential continuation of the previous uptrend. Bearish flag is the opposite and indicates a potential continuation of a downtrend. Pennant. A pennant pattern is similar to a flag but has converging trend lines, forming a triangular shape. It signifies a potential continuation of the previous trend. Advanced candlestick patterns. Double top and double bottom. A double top pattern forms when the price reaches a resistance level twice, creating 2 peaks of similar height. It suggests a potential reversal from an uptrend to a downtrend. Conversely, a double bottom pattern forms when the price reaches a support level twice, creating 2 troughs of similar depth. It indicates a potential reversal from a downtrend to an uptrend. Head and shoulders. A head and shoulders pattern consists of 3 peaks, with the middle peak being the highest, the head, and the 2 outer peaks being lower, the shoulders. It signifies a potential reversal from an uptrend to a downtrend. Using candlestick patterns in trading. Confirmation. Candlestick patterns should be confirmed by other technical indicators, such as trend lines, moving averages, or volume analysis, to increase the accuracy of trading signals. Timeframes. Different timeframes can provide different perspectives on candlestick patterns. Traders should consider using multiple timeframes to confirm patterns and gain a broader view of the market. Risk management. Implementing proper risk management techniques, including setting stop-loss orders and position sizing based on the pattern's characteristics and market conditions, is essential for successful trading. Conclusion. Mastering candlestick patterns is a valuable skill for Forex traders. By understanding the various candlestick formations and their implications, traders can gain insights into market sentiment and make more informed trading decisions. It is important to combine candlestick patterns with other technical tools, confirm signals, and practice proper risk management. With time, practice, and experience, traders can enhance their trading strategies and improve their overall success in the Forex market.